When you talk about Warren Buffett's annual letters, they're all legendary, right? But the 1995 letter, that one's something special. It's not just a look back in time, it's a playbook. I mean, a timeless playbook for capital allocation, risk management, and just pure discipline. For any of us in the investment world, this isn't some dusty old history lesson, it's a genuine masterclass. So let's just dive right in. So the first thing you see for 1995 is just this incredible headline number. Berkshire Hathaway's net worth, it grew by 45%. I mean, think about that, in a single year. Any fund manager today would be popping champagne, sending out these huge celebratory letters, right? But Buffett's reaction, that's where the real lesson starts. He just dismisses it right away. He basically says, look, it was a bull market, a rising tide lifts all yachts. And you have to understand, this isn't some kind of false modesty. It's a really profound point about focusing on your process, not the short-term outcome. It forces you to ask the right question. So what was the real achievement that year if it wasn't the 45%? All right, so to answer that, we're going to break this down into 5 key takeaways from that letter. First, we'll look beyond that headline number. Then we'll get into their tale of 2 strategies. After that, we'll look at the Berkshire acquisition advantage, unlock the power of their insurance float, and wrap up with what might be the most important thing, the wisdom of admitting when you're wrong. Okay, so first up is mindset. The way Buffett just brushes off that 45% gain, that's a masterclass in discipline for any of us. It is so easy to get swept up when the market's flying high and think you're a genius. But he's showing us that real, lasting value, that's created by deliberate strategic moves, not just by floating up with the market. And this really gets to the heart of the matter. For Buffett, that market gain was just fleeting. The real win in 1995, the thing he was actually proud of, was buying 3 fantastic businesses: Helzberg's, RC Willey, and GEICO. These weren't stock tickers. They were permanent additions that would churn out cash for decades. See, it's about building an economic fortress, not just riding a temporary wave. So that long-term mindset, it leads us right into their core strategy. How does Berkshire actually put its capital to work? Well, it's not a one-trick pony. They've got what Buffett calls a double-barreled approach, and believe me, it gives them this massive, massive advantage. And of course, Buffett has this classic, witty way of explaining it. He quotes Woody Allen to make his point about being flexible. By being willing to look for opportunities in both private companies and public stocks, they basically double their chances of finding something great. Most capital allocators are stuck in one lane. Berkshire gets to drive on the whole highway. And look, the proof is right here in the data from the letter. It's not just talk. Over 30 years, their stock portfolio, their marketable securities, grew at a staggering 33.4% a year. At the same time, the earnings from the businesses they owned outright grew at almost 15%. That's the dual-engine model firing on all cylinders. And that flexibility, that is the absolute key. They can go wherever the value is. One day, it might be buying an entire furniture store in a private negotiation. The next, it could be buying a chunk of Coca-Cola on the open market. That optionality, that freedom to hunt anywhere, it's a powerful competitive advantage that I think a lot of people just overlook. Okay, so this brings us to one side of that strategy, buying whole companies. Now, we all know the stats, and Buffett says it himself, most acquisitions are a disaster for the buyer. So what's the puzzle? How does Berkshire manage to succeed time and time again? Well, for starters, it begins with just a huge dose of skepticism. He has this great line that the financial projections you get from sellers and their bankers, they have more entertainment value than educational value. He just doesn't even look at them. He's not interested in the sales pitch, he's digging for the reality. And this whole discipline is built on a few really specific advantages. For one, they don't have some 5-year strategic plan that forces them to go out and buy something, anything, just to hit a target. Every single deal they look at is mentally compared to their next best idea, which might just be buying more stocks. And of course, their reputation as a permanent, hands-off owner means the best businesses actually come to them. That lets them avoid those crazy value-destroying bidding wars. Buffett uses a Peter Drucker quote to get to the why behind all the bad M&A. And it's really a behavioral trap. Deal-making beats working. It's exciting. CEOs get addicted to that thrill, the chase. Berkshire's entire advantage here is that they have a rational, objective process that completely sidesteps all that ego and emotion. All right, now we get to the real engine room, the thing that powers this entire machine, insurance float. If you want to understand Berkshire's incredible long-term returns, you have to understand this concept. It is, without a doubt, their secret sauce. So, what exactly is it? Think of it this way. Float is basically an interest-free, and sometimes better than interest-free, loan from their policyholders. People pay their insurance premiums up front, right? But Berkshire doesn't have to pay out the claims until way later, maybe years down the road. And in all that time in between, Buffett gets to invest that money for Berkshire. Just look at this table. The amount of float explodes from around $32 million to over $3.6 billion. But that's not even the craziest part. Look at the last column, the cost of these funds. In a ton of years, including the 3 right before 1995, the cost was negative. Let that sink in. They were literally being paid to hold onto and invest billions of dollars that wasn't even theirs. And this chart just puts that advantage in perfect perspective. In 1995, if the US government, the safest borrower in the world, wanted to borrow money long-term, they had to pay almost 6% interest. Berkshire's cost of capital? Less than 0. I mean, that is the most powerful, most sustainable form of leverage any investor could possibly dream up. And because that float is so cheap and so stable, it gives them a superpower: patience. They can stomach the ups and downs of the insurance business. They can handle wild swings in the stock market because their funding source isn't going anywhere. This lets them make a trade that almost no one else can. They'll accept a lumpy 15% over a smooth 12%. They can prioritize long-term returns over short-term appearances, an advantage most fund managers would kill for. Okay, our last lesson here, and honestly, this might be the most important one for any of us as professionals. This letter isn't some self-congratulatory victory lap. It's a brutally honest look at what went wrong. And that level of intellectual honesty, that is the true mark of a master. Buffett doesn't sweep the bad news under the rug. He actually has entire sections talking about the problems in their shoe business, the slow decline of newspapers like the Buffalo News, and the new competitive threats that World Book was facing. This isn't just about being transparent for transparency's sake. It's about showing a real commitment to learning from what's not working. And when it comes to his own mistakes, he's just ruthless. He walks through his decision to buy Gillette preferred stock instead of the common stock and calls it a huge error. His words were that he was being too clever, and that cleverness ended up costing Berkshire more than $600 million in lost gains. Now that's the kind of mistake and opportunity cost that you will never ever see on a balance sheet, but analyzing it is absolutely critical for getting better. And then comes the final boss of intellectual honesty. At the end of a year where the company's value went up 45%, when the stock is just flying high, he looks his shareholders in the eye and tells them, "Charlie and I would not consider buying Berkshire stock at this price." I mean, seriously, can you imagine any other CEO saying that today? It's just the ultimate lesson in valuation discipline and what it means to truly align your interests with your partners. So when you boil it all down, this 1995 letter really leaves us with a challenge to our own process. It is so easy to get caught up in a great story, in the market momentum, in the excitement of a deal. But what this entire playbook reminds us is that maybe the most important decision an investor makes is knowing their walkaway price, knowing when to say no. So the question is, what's yours?